Warren Buffett and Berkshire Hathaway just sold a bunch of the S&P 500. They keep hoarding cash, so this is looking bad. What should we as investors be doing now? Looking here at this post by Warren Buffett's stock tracker, I noticed that Berkshire Hathaway fully exited the SPY and VOO holdings, which means they fully sold out of the S&P 500, which is definitely concerning. It's also concerning that Berkshire added a bunch of Domino's pizza because Papa John's tastes way better and it's not even close. Come on, Warren. Seriously, let me dive deeper with you so that you can understand. And I'll also explain a bunch of his other moves because it looks like he's trimming a bunch of the financial sector and getting out of financial stocks, which does not look good for the financial sector in general, or at least what he thinks. My name is Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. So after doing a bunch of research, this is the thing that's interesting to me. Warren Buffett held a bunch of money back during the early 2000s dot-com bubble and the 2008 financial crisis. He saw some of the writing on the wall and didn't FOMO in when everybody else was trying to get that easy money. He was buying up solid, sustainable business that produced a solid cash flow and relatively fair valuations while everyone else was jumping in on the things that were super high valued or overvalued just because they were all the hype at the time. Then, when everything came crashing down, not only did his portfolio not drop as substantially as his peers, he also had a crazy amount of cash sitting off to the sidelines ready to pounce. The Globe and Mail said it best here. Historically, Buffett has argued for keeping large capital on hand to guarantee Berkshire Hathaway's capacity for quick and forceful response when prospects present themselves. From this vantage point, cash is a tool in the investment playbook for both defense and attack. From a defense standpoint, it provides a barrier against financial uncertainty, enabling the business to withstand economic downturns free from the agony of selling other assets at bad times. Cash gives unmatched flexibility on demand. It helps Buffett to seize unanticipated prospects, requiring swift response, often during market crashes or when unusual assets lose value. Buffett's ability to buy significant interests or entire business at reasonable prices, free from outside financing, depends on this flexibility. Buffett makes sure Berkshire Hathaway can always make decisions others, who might be over-leveraged or cash-strapped, cannot, by keeping liquidity. This strategy emphasizes a basic aspect of his philosophy. Cash as a tool to take advantage of the inefficiencies in the market, not as a static part of his portfolio. With that much cash sitting off to the side and ready, one can make very fast and strategic purchases when other companies are going to have to figure it out and may need time to free up liquidity in order to make that same decision. Warren Buffett has been the pinnacle of patience, which is just so hard to do. Now you may be looking at this and saying, well, why does Professor G say not to time the market when Warren Buffett definitely has way more money than Professor G and is definitely a better investor than Professor G, and he's definitely timing the market? Well, it's not just Professor G saying that. Warren Buffett says the same exact thing for you as an investor.
I'd like to ask both of you, if you were 30 years old again and had your first $1 million in the bank, how would you invest it, assuming you're not a full-time investor, you have another full-time job, you can cover your expenses with other savings for about 18 months, no dependents?
Well, I'll be very simple. Under the conditions you name, I'd probably have it all in a very low-cost index fund, and it'd probably be, might be Vanguard, somebody I knew was reliable, somebody where the cost was low, and because you postulated that you're not going to become a professional investor, I would recognize the fact that I'm an amateur investor, and I would feel that unless bought during a strong bull market, which this is, hasn't been, I would feel that that was going to outperform to a degree bonds under current conditions over a long period of time, and then I'd forget it and go back to work.
It's in the nature of things that you aren't going to have a whole lot of screamingly successful professional investors. You've got a great horde of professionals taking croupiers' profits out of the system, most of them by pretending to be professional investors. And that is in the nature of things too. But if you don't have any rational prospects of being a very skilled professional investor, well, of course you should compromise on some simple thing like an index fund.
So right there he's telling you, stick to an ETF or index fund with low fees and that tracks a broad market index, something like the S&P 500 or the total US stock market. Plain and simple, the reason why you're not going to do well with Warren Buffett's approach of timing the market is because you're not Warren Buffett. You're likely not a professional trader, and even if you are, you're probably not consistently beating the S&P 500 like he says right there.
But if you don't have any rational prospects of being a very skilled professional investor, well, of course you should compromise on some simple thing like an index fund.
Yeah, and that you will not get that advice from anybody because nobody gets paid to give you that advice. And so you will have all kinds of people telling you how much better they can do for you than that, and how if you just give them a wrap fee or give them commissions or whatever it may be, that they will do better, but they won't do better. On average, 1,000 other people like you do the same thing. That group of 1,000 will do worse if they listen to the people that make pitches at them. And in the end, why should you expect, I mean, you'll get a perfectly decent return over a 30 or 40-year period by doing what I suggest. And why should you expect more than that when you don't bring anything to the party? The salesman will tell you that you'll get it, but you won't.
Now that's just a straight mic drop. Be careful with financial advisors. I sometimes get heat down in the comment section saying that I'm not a financial advisor. Well, I'm very proud that I'm not a financial advisor. I obviously can go and take the test and pass it and call myself a CFA or a CFP, but I'd rather give you the real information for free here on YouTube because my goal is to help people, not add to the problem and keep scamming people out of money. Also, most of the people that give me that heat down in the comments section, I later on find out that they're a financial advisor and they're definitely just mad because I'm giving you the information free and they would rather charge you for this. You definitely don't need them. You can absolutely do this on your own and get that financial freedom. So like I was saying earlier, Warren Buffett made some other pretty big changes within the portfolio in the last quarter. The company trimmed its stakes in Bank of America to 680.2 million shares with a value of $29.9 billion from $797.7 million. NU Holdings to 40.2 million from 56.4 million. Citigroup to 14.6 million shares from 55.2 million. And Capital One Financial to 7.45 million shares from 9.10 million shares. It increased holdings in SiriusXM to 116.1 million shares from 105.2 million, OXY to 264.2 million shares, and Domino's Pizza to 2.38 million shares from about 1.28 million. It maintained its largest holding, Apple, shares at 300 million shares, which were valued at $75.1 billion at the end of the quarter. A stake in another of its largest holdings, American Express, also remained unchanged at 151.6 million shares, valued at about $45 billion. Now, as far as the S&P 500 exit that Berkshire Hathaway went through, it's kind of interesting to me that they even held any S&P 500 at all, because they like to find value and pick individual companies, especially at a distressed value, and let them grow. But the total amount he had in that portfolio of SPY and VOO put together was $48 million worth. The entire Berkshire portfolio is worth around $270 billion. This would mean that the S&P 500 percentage was somewhere around 0.01%. That would be like saying that if you had a $100,000 portfolio and you sold a stock worth $10, that would really not affect you or change your investing portfolio in very significant of a way. So the S&P 500 portion was never a meaningful part of that portfolio. So this selling out of the S&P 500 shouldn't be taken too seriously or telling us that maybe it's time for us to exit the S&P 500. If you look back at any time Warren Buffett's ever talked about the S&P 500 or about the average American investor, definitely says that you should stick with it and stick with it long term, and that most people should just have about 90% of their portfolio in something like that. It is definitely concerning that he's not buying too much extra within the portfolio. He does have a lot of cash off to the side, meaning that he does think a lot of things are overvalued, and he's just waiting to buy something new. But I'm going to continue to heed his advice and just invest in a low-cost index fund that has a broad market index like the S&P 500 or the total US stock market. To see my favorite 3-fund portfolio, check out this video here or watch this video here to keep you going strong in your investing journey, and let me know what you learned.